like understanding uh when to take trades, when not to take trades, using the statistics to your to your benefit. It's more about that. Let me see. Uh, all right, we're gonna get started. So, everybody, thank you for your time. Thank you for coming in today. I know it's a Saturday. I know it might be early on certain times, but so this is in reference to. So first, we're gonna go. First thing we're gonna go over today is like gap fibs and how to play it using a uh, s- statistical spreadsheet that I give. The next one is to just talk about fibs in general, about like when you're just fibbing your charts out. So one is the intraday aspect. One is it can be intraday swing trading, long positioning. It can be all of that for the next one. So one will be intraday, and that's playing gap fill, the gap fill strategy that I have with the levels that I post in the morning and with that statistical spreadsheet. Then you have two, which is just talking about fibs and talking about the difference between deep retracement and shallow retracements and how to correctly fib from swing high to swing lows. The third one will be talking about just we'll be talking about like futures, and then like my daily flow, like when I start the day. So we'll go over like how I set my chart up, like how I set my chart up, how I like mark out open, how I mark out my chart before I start the day. And then the fourth thing would be just using probabilities and understanding what the probabilities that I put on NQ are and how to trade them. So we'll go ahead and get started. So the first thing is, all right, drawing your daily gap fib level. So usually I post this in the morning, but sometimes I don't post them if I'm in a trade. But I'm going to show you guys how to post these. Now I'm asking you guys for your, just integrity aspect. This is not to be shared outside of this room because it's very specific. It was taught to me by somebody who asked me to not share it with people who are going to try to monetize it in the wrong way. And so I gave him my promise that I would trust the people who I share with. And so just, the same goes, with you guys. So the first thing, how to draw your gap fibs. So how you draw them is in the morning, I look at the 358 candle, 3:58 p.m. candle, and I draw it to the 9:30 candle as soon as it closes. Now this can work on any ticker, anything that trades basically from who trades uh regular trading hours, and it also works on futures. So if futures will be the same thing. It will be from that last candle, with the last candle, the 2 minute as that closes, to the 9:30 candle once it closes. Now there's two things, right? If we gap up, you're going to draw from the bottom of the 358 candle to the top of the 930 candle. If we gap down, right, we do the opposite. We draw from the top of the 358 candle to the 932 to the 930 candle once it closes. You have to wait until it closes. Now you can draw this on a 5 minute chart if you want to. It works similar. You can draw it on 3 minute, 2 minute. I've seen, I know I've driven draw it on a 15 minute candle, 15 minute time frame, but I specifically draw it on a 2 minute because that's where I have pulled my data from in regards to the data in that spreadsheet that I send out. So it's important to draw these correctly because it will be the difference between where PZ is at and where OPZ is at. Now PZ is called the profit zone, right? And the profit zone will be anything that's a negative coefficient and down. So it'll be these. So anytime you see, it'll be the first profit zone is negative 2.36 to negative 6.18. The next profit zone will be negative 1.236 to negative 1.68. It's important you do it, that you draw it correctly, because you want the profit zones to be in the correct area, because on the opposite side, your positive coefficients will be your opposite profit zone. And there's a reason why, because of that. When we gap up or we gap down, there's a high chance that we continue in that direction, at least to hit this on almost like a 70% level over the last 2 years. So that's how long I've collected my data from. It can go back a little further than that, but at least on the 70% aspect, we go and we hit that profit zone. And just to show you, I'm not pulling, you know, kicks and giggles. So 73% of the time, 74% of the time, we hit profit zone, uh, whether we gap up or we gap down. Now, there's certain days in which a gap up is more important, right? Because on a Wednesday or a Tuesday, if we gap up, there's an 80% chance that we go ahead and hit the profit zone. If we gap down, your better days will be your Wednesdays. So that's why that's important, because OPZ doesn't have that high of a um overall. It's about 50%. Because if you think about it, usually if we're going into the momentum of something, if we gap up or we gap down, typically momentum continues to push us in that direction. So it's important to know how to draw these, because if I say, okay, there's an 80% chance that we hit profit zone, and then you draw it the wrong way. So instead of drawing it that way, you draw it, you really wouldn't even be able to draw it this way, because it wouldn't work. Or even you try to draw from here to here, right? You'll say that your profit zone is up here, but that's not true, right? So you got to make sure you draw it the correct way. So, all right, everybody good with that? 358 candle to the 930 candle. If we gap down, you draw it from the high of the 930 to the low of the 930 candle. High of 358 to the low of the 930. If we gap up, right? If we gap up, you draw it the opposite side, right? From the bottom to the top. Now, what happens if you have an engulfing candle, right? You have an engulfing candle, you're going to basically look at where we closed at and where we opened at, and you draw it in that direction. We rarely have those. So, like, if we have those, just let me know, and then I can kind of guide you in that light. But going back to here. So, all right. So, so here you have your opposite profit zone, right? And I usually like to draw my boxes, right, with a something like kind of like a in the middle type of thing, because what I've noticed is that over time, if we cross below 50% of this and we don't reject it, like, if we don't reject it, we'll continue to push through. And I'll show you what it looks like on what happened on Friday. So now your other areas that you need to know are this area here, 0.236 to 0.786. The reason why is because I call this my retracement zone. This is very important because a lot of times when price either gaps down or gaps up, it will retrace in this area and then continue in the direction. Or what will happen is we'll hit the one side and we'll start to go up. And I'll tell you guys, hey, we're in the retracement zone, or you can target the retracement zone. Now, if we push through the retracement zone, there's a good chance that we go to the other side. And I'll show you guys that too. Now, there's another area that I call the no trade zone. And the reason why I call it the no trade zone is because you really don't have uh, any levels in between here from an intraday aspect when you're looking at when you draw your levels. So in here and in here, you can take trades if you want to, but I call it the no trade zone because you don't have any lines of support or lines of resistance to help you, kind of tailor your risk, right? So if I take a trade here, or I take a trade here, we push up, take a trade here, right? Even though like it's in the no trade zone, you know that you have at least this level as your, your support. Or if you take it here, you can have 50% as your support, right? And I would say that if this wasn't such a big box, right, I would say that 50% of this would be pretty decent. Or you can go and you can do a, uh, where is it at? You can do one of these and you can say, okay, 75% would be my stop, right? And then because if it's a big box, so this is a 30-point box, right? That's pretty big. Usually they're not that big. And so but now that you know, right? Profit zone is going to be that first green and red box, and then the next green and red box, but they're always going to have negative coefficients. I don't know if you guys can see that, but it's a negative. The negative 2.36 on down. So here's a good example here on this gap level strategy. So negative 2.36 is the first one, the second one, the third one, and it continues. The retracement zone is going to be your 0.236 to 0.786. Your opposite profit zone is going to be 1.236 to 1.618. And then as we go up, and if we continue to go up, this will be your next one, right? And so on and so on. The area between the profit zone and the and profit zone and retracement zone is no trade zone. The area between the retracement zone and opposite profit zone is a no trade zone. Everybody understand that? But now the other aspect is gap fills. People, I know pretty much everybody understands that aspect. Gap fills is if we fill the gap. So that's important when you're looking at the sheet because then you'll know the percentage of us, potentially filling that gap. And when that percentage is a full gap fill, it's not a 50% gap fill, it's not a 25% gap fill, it's a full 100% gap fill. Scenarios. We're going to go over some different scenarios. There are 4 scenarios. And so let's do this. So I'm going to hide the price. So let's do this. Scenario 1, scenario 2, scenario 3, 4, scenario 5. All right. Scenario 1. Scenario 1 is in which we gap down, right? So price starts here, it closes here from the previous day, gaps down, and shoots straight to the profit zone. That is a scenario 1. If we gap down, if we gap up, it will be the same thing. Right? Say, for instance, this was the actual profit zone. We gap up, it goes straight to the profit zone. Those are your scenario 1s. So gap up or down and goes straight to profit zone without retracement. Scenario 2. Scenario 2. We gap down, we do this little move, and we go to the profit zone. Gap up. Oops. Gap up. Sit in the no trade zone for whatever time period, and then go hit the profit zone. So assume this is the profit zone while we're talking. All right. So let me actually make this here, make it realistic, right? So gap up, gap down, sit here for a second for every time, and then go to the profit zone. So scenario 1 and scenario 2. Hesitates in, there we go. I'll shorten this. All right. So the difference between these two, one hesitates, one doesn't. Now, the one thing that they have in common is that they go to the profit zone without going to the retracement zone. And it's important because of scenario 3 gaps up, goes into the retracement zone, and then goes to the profit zone. Gaps down, goes into the retracement zone, and then goes into the profit zone. This is my favorite one to play. Uh, and the reason, and I want somebody to, yeah, I need some type of wisdom, Cream 17, OG, anybody who's been trading. Why would I want it to go into the retracement zone if I'm trading SPX options? Anybody can answer. There you go. Discount. Thank you, Green. If we gap up or we gap down, those premiums are going to be very high, right? Typically. If I think that we're going to continue down, right? I want to catch it. I want to get it in here. I don't want to get it down here. I want to wait till it comes up here, give me a cheaper price, and then go to where I expect it to go to. So that is why it's my favorite one when I'm trading options. So gap up, down, goes into retracement to RTZ, then goes to PZ. Let me see if I can make this a little bigger for y'all. Come on, click on for me. There we go. All right. Add some space between these things. There we go. Now we're cooking, y'all. Now we're cooking. All right. Scenario 4. Scenario 4. Move this out the way. So say if price closes here previous day, we gap up. We immediately fill the gap. Or we fill the gap before hitting the profit zone. That's a better way to say it. Gap up. Instead of hitting the profit zone, we may even do this little thing in which we move in here, but we fill the gap before we hit the profit zone. Same thing, gap down, may do this thing here, boom, 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 and then we fill the gap. So scenario 4, sorry, fills gap before hitting PZ. Now it may hit PZ after. I don't care about that. I care about did we fill the gap first. So scenario 4 always fills the gap before hitting PZ. All right. Scenario 5. So if scenario 1, we hit PZ. Scenario 2, we hit PZ. Scenario 3, we hit PZ. Scenario 4, we fill the gap. What would be scenario 5? And it's the least likely thing to happen out of all the scenarios. Make sure I'm saying that. Yeah, scenario 5 happens 5% of the time, and it happens typically when we have a big gap. If I can find the day that we did scenario 5. All right, 12/17. So let's go to the date real quick. I don't know if it's gonna let me go. Don't let me go on this thing. Uh, let's do it 3 minutes. And then let's see what it gives me. Oh shit. Y'all ain't tell me I got this shit hidden. All right, here we go. Go to a 2 minute. All right, here we go. So scenario 5, we go ahead and hit our gap fib on. All right. So here's yesterday's close. Right. Here's your PZ. Got close to hitting PZ. Didn't really get close to hitting filling the gap. We did hit RTZ. So scenario 5, we don't hit PZ and we don't fill the gap. So FYI, that's why that's the least likely thing to happen, because typically when we have momentum, right, we typically go hit. We fill the gap if they want to catch people who are in late, or we hit PZ to continue the momentum. But if we don't hit either one, it's a scenario 5, and it typically happens when we have a big gap from the previous day to where we open. Like I said, it's 5% of the time. I think that like my data is over. It might be over 2 years now. There's been 435 data points. It's happened 23 times. That's very low. I'd say it doesn't happen, but you'll notice when I'll say something like, okay, we got 40 points, because the average gap is 37 points on scenario 5s. So that means that might be a 100-point gap, 50-point gap. It's very rarely a gap less than, I think, what's the smallest gap? The smallest gap was like 18, and that was like a Wednesday maybe. But typically it's on your big gap days in which we have a scenario 5. All right. Everybody clear so far? Let me move this out the way. Everybody need to take pictures of this aspect here. Take a screenshot if you need it. I appreciate it. Appreciate it. 33. All right. So yeah, actually, hold on. Don't take a screenshot yet. Doesn't hit PZ nor fill gap. And then just the asterisk usually happens on big gap days. All right. So let's recap. Scenario 1, we gap up or we gap down and go straight to profit zone, right? Without retracement. And if there is a small retracement, it is very small. When I say very small, it'll look like this. If the first candle is, let me get rid of all this. Say for instance, the first candle is this big, right? It may not even go 0.236 of that candle. It's very, very specific. We go straight to the profit zone. All right. So now I'll say this. If we open up in the retracement zone and we go straight to the profit zone, I count that as a scenario 1, because it never retraced back into the retracement zone. It just happened to open up there. Now, if it opens up in the retracement zone and does some type of move, or goes up before it comes back down, or it starts up here, or if it's a gap up and it moves even a little bit in here, that's a scenario 3 for me. Scenario one, you're going straight to the target. You have one mission in mind, and that's going straight to profit zone. You're not letting anything get in your way. Scenario two, we hesitate and it's no tracement zone, no trade zone. Now I call it no trade zone. It does not mean that you cannot trade there, but you have to understand that if you trade there, that you don't your distances between your your levels is further. All right. Number three, we gap up, we gap down, and we go back into the retracement zone, into discount, right? Big boys let their friends in, and then we go straight to profit zone. We should go straight to where the intended target is. Fills gap before hitting the profit zone. That's scenario four. Gap down, we gap up. Instead of hitting profit zone first, we go retrace and we fill the gap. Once we fill the gap, we then may go hit profit zone. We may go straight and hit the opposite profit zone. I don't care about that. All we care about is we complete scenario four by filling the gap first. All right, we're good there. All right. Scenario five. Doesn't hit PZ nor fill gap. Usually happens on big gap days. Far and few between. It's something that I can typically spot because we've gapped up or gapped down pretty big. But uh, it's something that, like I said, you'll see it on the spreadsheet at like 5%. Sometimes you'll see it at 0%. You won't see it higher than, maybe 10% chance. And that's on like odd days in which we have, something weird that happens. All right. So now everybody got this part? All right, good deal. This is what I'll do. Um, actually, no. Everybody who wasn't attending class, they just need to watch the video. We'll do it like that. All right. So now the next thing you guys need is the settings. I just call this Monday Fib because it's the Monday Fib and it's for part of the lesson. But this is the same fibs set that I use uh, for when I plot my fibs. So you can take a picture of this. Now, sometimes what happens is if we go further, right? Say if we go further than 0.5236, I'll come and I'll change one of these to 0.6, 0.36 to kind of give me more levels uh above or below. So take your screenshots of these. Everybody good? Yep. So the on Monday or your fib in the morning gaps on the 2 minute. Yeah, the 2 minute cream. Now, like I said, you can if you're not fast enough, you can do it on the 5 minute. I do it on the 2 minute because I'm usually in trades already, and I need to see, definitely for futures, right? So if we go to NQ, right, and then I'll buy NQ, right? So NQ in that regular time frame, you really won't see when I'm already in a trade. I really won't see what's going on, right? Because it's already been moving. But if I change it to regular trading hours, right, and I go find my 358 candle. Now, if I go back to electronic trading hours, right? Now I can see it, right? So and I can see okay where we hit something at right at 940, boom, hit the opposite profit zone, hit the profit zone, came back on down. So yeah. So it's always on the 2 minute for me. You can do it on the 5 minute because with options, sometimes you don't want to get into a trade as early as I may get into a trade with futures because you want the market to settle down because of IV and because of just prices being, the prices being a little higher than normal. So you kind of want the market to settle out from the volatility. But I may have already been into a trade with futures like up here, right? Even though I don't have these fibs yet. Now I'm at 932. I've got this fib now at 940. Now option traders may not already be into a trade unless you're playing on momentum, right? So I may need to know this is here because if I don't know this is here and it shoots back up against me, I'm kind of in a bad, I could be looking real good to looking real bad, right? So it's totally up to you. Like I said, uh, where we draw them at, keep that in this room. Or what time frame you draw them at, keep that in this room. All right, so going back to SPX. All right, so let's look at. We're gonna play the week out. So let's go open up. Let me see. What was the first day of the week this week? Well, no, last week. 12:30. All right. And we got down on 12:30. So, all right. So when you're looking at this, right? So, oh, this isn't it. 12:30. Did it save the wrong one? All right, let's do this. I think I saved over this one by mistake. All right. 12:30 is a Monday. So gap down on a Monday. Uh, and we had no news, right? So we'll just look here, right? So gap down on a Monday. There's a 66% chance that we go up, right? So, and it usually happens around 10:15, and I'm looking for a move about 24 points, right? So 10:15, we're hitting this PZ. 10:30, we're starting to make our move up, right? Now, what you'll notice a lot is that when you're looking at these, we make a lot of reversals around the 10 o'clock time to 11 o'clock time on average. Why is that? Because when we get that 10 o'clock flip, right? Typically 9:45 to 10:15, we start making our move from that 6 a.m. to 10 a.m. futures candle to now the 10 a.m. to 2 p.m. futures candle. And so typically that 10 a.m. candle is going to be your distribution candle. So what you'll see is if we start the candle here, right, you might get some manipulation and then you might get your move up. Right. So that's why that 10:15 will start to move. Yep, exactly. Yep. So then on your PM, if you see PM, you'll notice that a lot of the moves will happen anywhere between 1:30 and 2:30 and 2:15. Why? You get your algos. Right. So the data helps make you feel confident when the admins call out trades, right? So it's like when 33 is saying, hey, algo at 2 p.m., you need to start looking at where we're at on our levels. If you're using this, if you're not using this, fine. It's up to you. But understanding that, okay, typically we may have a move around these times. I need to start looking about 30 to 45 minutes before and about 35 and 45 minutes after to see where we at level wise. Does that make sense to everybody? All right. So here, right, this would have been a scenario one. We shot down, we had a small retracement, and we came straight down. No real reversal on any candles, straight down. I mean, you could call it a scenario two, but I would give it a scenario one. And from there, right, although we had a move down, We're actually looking for the move up. So the move up is a lot bigger than the move down. We will consider it a move up. And so when I look at moves, I'm looking at them from specific areas, right? So I'm not count if it's not a move that's over 15 points, it doesn't count as a move on SPX to me. Because a move of 15 points, if it's not done fast enough, you can get killed with theta depending on how the market is, how the market is moving. So if we're just doing this and doing this, doing this, if you go too much out the money, that 15-point move may not get you a substantial amount of money. Now, if we have a it's not always guaranteed that we're going to have a big PM move like we're going to have a big AM move. The AM moves are always going to be your bigger moves unless there's some type of news in the PM or just the algos want to just kick people back into shape, which they may do on like a Thursday or Friday or Wednesday if it's FOMC. Now with VIX up a little bit more, right? Then our moves have been bigger as you've seen. So uh you'll notice that moves may be 20 point moves or 25-point moves, in which, earlier last year or in some time back, VIX was low. So the moves weren't as, they weren't as big. They weren't as volatile. All right. So let's go to actual Tuesday since we have Tuesday. Since we know we have Tuesday. I need to start saving these when I'm done with them. All right. No, this saved is Thursday. So let's do Tuesday then. Mm-hmm. See what it's doing. All right, so Tuesday, what do we, let's see, erase this. And we'll go to Tuesday's Phillips, right? All right, Tuesday was a gap up day. So 52% to 48%, right? Now this is a closer percentage, right? Anytime you see a closer percentage where it's like not 60 to 40, I'm going to kind of look at playing both ways, right? So I'm not going to be as biased to playing one side. And if you notice, we actually go down, right? And where did we go down from, right? Now you can say we went up too, but where was the actual meat of the move in the AM? So AM is anytime between uh 9:30 and 11:30, and PM will be 12 to end of the session. So if you notice in this area here, your no trade zone, and even you could have said that we hit it from the profit zone, right? So there's a 67% chance that we would, or 71% chance that we would hit the profit zone. So that's pretty high. Anything over 70, right? I'm looking to take trades up into that direction, but I'm looking to get it from a retracement zone, or I'm looking to get it from a discount if we're so close to it already. So from here, this 22 to this 29, that's 7 points. That's not enough for me because if we go and we fill the gap, I'm losing 13, 14 points to fill the gap versus just hitting 7, 8 points to hit this profit zone. So I'm going to wait until we come back into the retracement zone, which it says if we're going to go up, we're going to go from the retracement zone on Tuesday, right? And where do we go? We hit the retracement zone, go up, hit the retracement zone, go up, hit the retracement zone, go up, hit PZ. Now, on the down move, right? Look for move to start in NTZ. Well, it hit profit zone, but that NTZ was basically telling you we're not pushing past that with any authority. Because if we did, we would have pushed past the profit zone with authority and at least went into the box of the profit zone. we're tagging it, right? So from there, you could have taken your trade down once we noticed we stopped like that. We were kind of just hesitant. We just weren't. We had no type of strength, right? And so from that move down, what did you get? It doesn't matter where you want to put it. We'll put it down here. You're looking at what, 31 points, right? Or if you want to say 45 because it's the full move, we didn't really get any real reversal from there. So it's up to you, right? We end up filling a gap. So a gap fill percentage, you want to mark this in your notes. Anything over 65% is decent enough for me to try to go for the gap fill. I prefer 70%. 65% is tradable. 70%, I'm hunting for it. All right, makes sense, everybody? All right. So now let's look at our OPZ, right? So PZ. So all right, we know the percentage that I like for here, right? 60-40, right? If 60 is on one of these, that's preferable to me, right? Gap fill. 65%, I'm trading. 70% and above, I'm hunting for it. I'm looking for uh entries to take it back down. Right? So my entries aren't going to happen here, right? That doesn't really make any sense because as we know as traders, they like to fake out the gap fill at least 1 to 3 times before they actually gap fill it, right? But if I take it up here and I know that I have a 67, 65 to 70% chance of filling this gap, I'm going to take those every time. All right. I'm going to come back to this part here. So from a profit zone and an OPZ aspect, anything that is over 70% for PZ, I like. 80%, I love. Just FYI. 70%, I like. 80%, I love. 80%, I'm holding with confidence. I might walk away from my computer. 70%, I'm gonna manage that a little bit more. Anything under 70, I'm I'm making sure that I'm taking the best entries, if that makes sense. But say for instance, instead of going straight to PZ, we pop down, fill the gap. If I know this is an 80% chance and we start to rotate back up, I'm taking that up and I'm going for PZ. They're gonna have to knock me out the trade. And I might, I'll probably pick candle to candle. But if we start getting, if this here was down here, I'm taking that and I'm going after profit zone if it says 80%. Now for your scenarios, what you'll notice is that these will be your highest scenarios. Scenario one, scenario three, scenario four. Now remember, scenario one and scenario three happens before scenario four. Scenario four and scenario one and scenario three all lead to PZ being hit, right? Scenario four happens before these, but that does not mean that PZ can't still be hit after we fill the gap. So if you see a scenario four being high, that does not necessarily that means that we're going to fill the gap typically first, and then and if you see a high PZ, that means that we'll typically hit PZ first or do the gap fill, and then we'll hit PZ after. Now in this situation, we hit PZ first, and then we fill the gap, but that will kind of lead to this aspect here. So these you'll notice that the percentages kind of play into each other, right? If we have a gap fill, well, all four of these can be gap fills, right? These lead into this. Gap fill and a scenario 4 kind of go together, but they also can be OPZ because of the fact that if we come down and hit OPZ, that typically that 100% mean if we hit the OPZ, that means we fill the gap. As you see, 52.38, 52.38. They don't always match, but when they're high together, I'm looking at us to go fill that gap first. All right, so let's move on to the next day. Because here, what do we do for the up move? So here, 140 is 1240. So if you see 145, like I said, start looking for a trade from 12, probably about 45 minutes, maybe an hour before, and start looking for us to get, if we move down like that, start for us to get some type of little lunchtime reversal or some type of reversion back into the range to create that bottom wick of the candle. So from here to here, what is that? Maybe is that 15 points? 19 points. And it's already telling you if we're going to move up, which we do 62% of the time, we're typically going to move up off of OPZ. Now OPZ can be any one of these, right? So here, this is all considered OPZ. Each one of these lines. But don't just take a trade no reason. But if you say, for instance, you get in here, put your stop a little bit underneath, whatever you feel comfortable with, 5 points, 10 points is up to you. And start looking for upwards if it says something like 60, 60%, definitely 60%. Make sense, everybody? Anybody got any questions? All right, so let's go to Thursday. And so, like, what I would like, people, like this. Some people use it, some people don't. Some people use part of it. If you like it, whatever. Me putting the spreadsheets in there is for you to kind of use those to go over as homework as you get comfortable, right? So that muscle memory, that's why I'm kind of going. This is the first class where I'm actually going through this day by day. Usually we kind of go through it at some point, but I want to get you guys to kind of see what I see, right? Because it's a very reactive system. So, you know, I've thought about coming here and calling trades using this system, but because it's so reactive and because SPX is so volatile, I'm very mindful of, and because I kind of trade NQ anymore, and then shit, 33 and Vince, they got SPX on lock. So there's really no need for me to call out SPX trades if you guys have the percentages already. You have those guys who are SPX sharks calling out. This is just to kind of give you confidence and kind of give you an idea of, okay, if we're hitting a specific level, maybe I need to take some position off, right? And you'll even hear me say, I'll call it out. Hey, we just hit PZ. 33 will be like, you know what? Let's pull off some of our position. Or if he feels that we're going to continue up, hey, bring your stops up. Everybody kind of, be, be careful with your risk, right? So it's all, team, definitely a team type of thing, right? But it's all also knowing where the levels are at to kind of know where you can take trades when you can't take trades, right? And so all right, we'll look at, is this Thursday? This is Tuesday still. All right, this is Thursday. All right, Thursday. So it's NTZ again. So here, right, 42% chance that we go up and 58% chance that we go down. Now you see we did both, right? Hit our 42% chance that we would go into RTZ and bounce up. Right? We did that. Now I only count one move. I don't count both. It's whatever the bigger move is. Is that and the one that is a move off of a specific off of a level. So it just happens that on Thursdays in which we gap up, we usually go down. Higher percentage area that we go down from is NTZ. Although it may be, not that much of a difference, but if it's 30% and all the other ones are 20%, I'm going to say look for a move to start in NTZ. Now, mind you, here, I would say that the move started actually from PZ and then went down, right? So here, 70% chance that we fill the gap, right? Again, like I said before, I'm not taking a gap fill down right here. I'm taking a gap fill once we go up here. Or I may add I might start my position here, add one here, right? Now I've gotten a pretty decent, right? So if I say if I add my position here, once I get here, right? In essence, I'm close to break even. You might even be better than break even. It depends on how the contracts are working, right? And then you get this flush down, right? Then you could possibly add another here, and boom, we go fill the gap, right? So if you notice, right, tried it once, tried it twice, third time was the charm, right? So remember when that gap fill happens, you don't always have to take the first one, always don't have to take the second one, but typically that third or that fourth one, we typically fill the gap, especially if it's a high percentage. If you see a high percentage here, especially. What time did we fill the gap? 11:04. Average gap fill 10:55. This is not me putting in these numbers. It's just the average of times we fill gaps on these type of days. So, but if you guys notice, right, what happens when 33 is on the mic, right? He's like, man, I've seen this type of day. Vince, I've seen these type of day. Only bags, I've seen this type of day, right? Who else? All the admins, Johnny, or not John, Hawk, all of them, right? It's because we do the same thing every single day, right? And if you have percentages behind it, now you know, okay, if it says 70% of the time that this is going to happen, right? And I bet and put the same, you know, investment in, I can lose those 30. I can even size to zero and lose 30% of the time and win 70% of the time, and I'm okay with that. That's my personal opinion. So, when you're playing percentages and when you are looking at it from that way, that is not I trade. I trade off of using statistics. I do use other indicators and stuff like that, but statistics are what keep me confident and into trading. So here, right now we look at this 68%, 60%, right? This ain't high for me. So I probably wouldn't have taken this, but I would have taken this to us first the gap fill and for us to hit OPZ. Because like I said, OPZ, anything over 50%, I like my odds. Especially with a high gap fill, especially with a high scenario for. If I hit both sides and I took both sides, we cooking for that day. I'm popping champagne that night. Then you have your PM move. If we go up, right? Look forward to bounce off of OPZ, right? Now this is on a 2 minute. If you draw it on your 2 minute, right? Go to your 5 minute. Looks a little bit different, right? Clear rejection, right? Push up, boom. There you go. If we were to go down, PM session, it would have been typically it happens off PZ up here. But remember, PZ, negative coefficients, coefficients, OPZ. Any questions so far? All right. So I'm thinking everybody, oh, we got one more. Let's do one more day, right? And then we're gonna go to Fibs. Fibs from a higher time frame aspect to like a kind of a swing trading aspect. And knowing what levels to take things off of when you're actually fibbing for, for bigger moves than just intraday trading. So all right, we got Friday. All right. So what did Friday give us? All right, Friday was a gap up, 50-50, right? So if we go up, we're taking up RTZ. Boom. 10:01, I'm starting to look for my trades. 10:02, boom. Now you could have taken this down from the rejection here, right? And then, but the issue is on a Friday in which we gap up, not a very high gap fill rate, right? I don't know if I'm taking that, especially with PZ being 81%, right? So scenario one, highest one is 36%. We have a little bit of retracement, so you can either call this a scenario one or scenario maybe two. But I would probably call it scenario one because it's just this big stick here. You really weren't in uh it's pretty much a straight shot. Definitely if you go to like a 5 minute, right? But 2 minute there, and then later in the day, 64% chance that we move up later in the day. 1 o'clock, boom, we got our little move up. Got your 19 points. Not necessarily 24, but decent enough. A lot of people, I think y'all made a lot of money going, not necessarily going from here, but y'all made a lot of money in the morning taking those calls. I think some people even took puts. So you had a nice little move down, and you had a nice little move up. Up got you about 40 points from the RTZ, and good to go. All right, done with that. Any questions so far? All right, so we're gonna leave that there. All right, so go ahead.
So one thing, I don't know if you do this. I'm probably sure you do, based on how well you're a statistical trader. But there's a lot. I think a lot of mistakes are being made where people are taking contracts that are too far out of the money, and you know, based like you said it earlier, where you're like, you know, if I don't get X amount of points on this move, it's not worth taking the trade because of theta and the time that it takes, right? And we all know that you can take out of the money contracts and make money on a down move because down moves have a lot more speed, but up moves don't move as fast as down moves. Do you have a way where, based on where you're at or where you're entering off PZ or whatever zone you're targeting, to say, okay, this is the type of contract that I have to get in one strike out of the money or two, three strikes max based on the expected move?
Yeah, so with VIX up, right? I'm gonna tell people to do what you can afford, but get closer to in the money because the contracts are already expensive, right? And so if you see that, all right, we're into the retracement zone, right? And it's 588. I wouldn't go anywhere above maybe 5905, to be honest with you. Um, Maybe 5910 because then you'll be 4 points in the money. And if we get there before 11 o'clock, we're good, right? But I would probably go no more than 2 or 3 strikes out the money. And that's in the AM. Now, PM is a little bit different because you can, the contracts are cheaper, right? PM, get one out the money, maybe two, but do what you can afford. If you can't afford that, trade SPY. Make your money doing SPY, build your account until you can afford SPX at this moment. SPX with VIX being up, it's more expensive. It just is what it is. Now, the contracts move a lot better, in my opinion, but you have, it's just the buy-in to that party is just a little bit more expensive. If you can't afford that party, go play at the SPY party. The SPY party has plenty of drinks, plenty of ability to make money there too. You just got to pick what you can fit, right? So I would always say, right now in this type of market, if the target is 59.14, 59.10 is the highest that I would take. Now, it has to be relative to your account, right? If it's a Tuesday or Wednesday, you can go a little bit more out the money because those are our moving days, right? Tuesday through Thursday are our moving days. Fridays, now you get, Fridays, everybody's 0 day for the most part. So Fridays, if you don't want to trade SPX, trade something else that's going to be cheaper than SPX and still make a lot of money. and you can still use gap fibs. I just don't have the statistics on all the other ones. It's just my statistics are more so catered to SPX. Answer your question, 33 for everybody.
Yeah, that was perfect. I think, I think we like it's maybe my fault, but I think, one thing that I really want to make sure is everybody knows exactly what contracts to buy because,
Mhm.
yeah, obviously, you get out of the money further, then, the contract does go, then you get this like cool little high percentage gain, but it's dangerous. The further out of the money, as you go, the less likely you're actually able to make money on that contract. So I just want to, I think that's going to be a big focus for us this month is making sure everyone knows what contract to get into.
Yeah.
Because, for example, I know OG's on here. It's a perfect example. I'm not trying to pick on him, but his entry wasn't the greatest when him and I went through his entries, and that's okay, right? Sometimes you don't get a good entry, but we want to have the best entry. But if you don't get a good entry, but you have a good contract that's not too far out of the way, you can get away with it,
Mhm.
right?
Yes,
You know,
100%.
because
100%.
that fate can just roast you on a move away from your direction you're looking for. So we'll focus on that. I appreciate that because
Yeah.
that's
And I
huge.
and
I
I'll
think
say
a lot of traders. Go ahead.
I was like, I'll add to that, right? The better you are at trading SPX, the more you can go out the money because you're better at gauging, you're better at getting entries. SPX is an entry important ticker. Definitely when you go out the money. So if you're like you say, if you're closer in the money, you can afford being a little like, a little more, it can, you can like what's the best way to say it? Your entries don't have to be as good. Like the other day, I took a bad entry on SPX contracts, and I was in somebody else's account, and I was down maybe $3,000 or $4,000, but I was close in the money, so I didn't feel the pressure. Right? If I would have been way out the money and 3 or 4 thousand down, I would have been irritated. Right? I would have probably gotten out the trade because of the fact that it's a lot harder for those out the money to then go back to break even and to actually make you money once they go once they lose so much value. So be mindful that you don't want to keep adding if you don't know what you're doing to trades like that. So to me it's very important, like, because I know, Vince may get out the money contracts, but he's a fucking in 33, but they are excellent ass trades. Now, at 33, I feel gets more closer to the money, but you might see Vince get out the money, contract, but he is a fucking killer when it comes to that shit. That's
My
not me. Right?
strategy, my
So
strategy on SPX is I only go further out of the money when I'm targeting downside moves. I
hmm
don't,
hmm
but I always keep it closer to the money on upside moves, just purely
yeah.
because it takes longer to move up. And usually when the market moves up, it moves up on what? Lower volume. The market sells
hmm
off, it picks up speed, so it moves down faster because why? You need to sell more use more volume to sell so you get more speed. So you can get away with it. But that doesn't mean you're gonna be taking, 60 out of the money. You gotta look at the VIX, where the VIX is at, the kind of move that we could expect based on what your statistics are showing, based on the supply zone, based on Vince's schematic, all that kind of good stuff. So then you can kind of gauge it. And Vince says, "Hey, I'm taking 58.50s, and we're at 59.10 or 5900." Well, maybe you don't take those. Maybe you take the 59.70s and grab just one. Because you're
Yeah.
still going to make great money.
100%. Because if it still goes that way, you're gonna be in the money. You're gonna make it like there's times, and I usually I don't take trades from other people, right? But if I see the same thing, I'll take the same trade. Now I'll take some of 33 swings and stuff like that. But I believe in his swing trading. But I'll if I hear somebody call something out and I see the same trade, I may not get the same contract. I may get a contract that's better suited for my personality, my risk management, my anxiety, all of that, right? All that plays into it, right? You know what I mean? So you just gotta be your own trader, but still learn from the admins that are here, right? That makes sense. Know what your personality, know what your mental can take when you're sitting in a trade. You know what I mean? Like Vince can go take a shit and leave his thing and all that. I may not be able to do that. I may have to sit here and do some yoga. Y'all know I used to talk about doing yoga. I'm dead serious. Might have to calm my mind down and whatever. If I, you know what I mean? Everybody's different. You have to know what you can do, right? And so, like 33 said, and where you might have gotten 10 contracts, get one or two that's more expensive and still get the move, it's still going to be more money than typically people make on a day-to-day fashion. Just being honest. After that, it's just that's a personal thing of whatever, right? So, but yeah, I always
And
say right now, if you're going up 2 or 3 out the money, going down, you could be a little bit more risky because you have all the aspects of the market. You have fear. You have people who, people see the market fall and they just like to sell and get out. And, when those, that's just how the market goes. It falls faster than it goes up. You know what I mean? So that's just why people like playing shorts. That's why people like playing puts because of the fact that they can make big money so quick. And definitely when it has the value to push it. Right. So,
nice. And exactly. And the last thing I just want to just a little interject is if you guys hear of like, okay, Vince say, I'm looking for, 5,800 or 5,823, or, me, I'm saying, like on for the meta calls, I was like, I want 602 and then 604 to 605. Okay, just because we say that doesn't mean the price will actually go there. You know what I mean?
mhm.
And you still need to 100% manage the trade. And move, you get up, 30, 40%, you scale a chunk off, and then you move your stops up just above break even. And then you stair step it up. Okay, now you're up 100%. Now you take half or three quarters off of the whole trade, and then you move your stops up a little bit more. And then you let it run. And when you're like, okay, shit's looking a little extended and I'm up 400-500%. All right, this is enough. Let me just lock this baby in. That's kind of how you want to go about it, or if you're like, okay, I'm up 50% quick, man, let me take one off on this SPX. I got three left. Let me move my stops up to up 20%, and boom, you get stopped up. That's okay, because at least you didn't let a 50% positive trade go back to break even or take it to red. Like you really got to make sure you're stacking the wins. That's like huge.
Yeah, very huge. No, you're right. Just because we say something, and you can always ask us, right? When did we get in from a price level standpoint? Contracts is hard to tell people when you got in from a contract standpoint because people may have added contracts, whatever. But if you can, guys can always ask before you get into a trade, hey, what price did you get in on SPX? When we're already in the trade, yeah, we're managing the trade, but we don't mind telling you, definitely if we're on live, right? So don't just hop in because you can hop in and we may already be 50, 60% in, 60% up, 70% up. And you get in and then we pull back a little bit. Now you're down 20, 30%. And you gotta close your contract because we tell you guys close them out at 20%, 20% loss. So you got, just be mindful of when we enter versus when you guys are entering if you don't enter at the same time. You know what I mean? And then also understand everybody has different risk management when it comes to what they're willing to go down on their contracts or go down on their investment. You know what I mean? Everybody account size is different. Take that in consideration too. So um yeah. But no, that takes care of Phil's. If I'm gonna take like a quick like 2 or 3 minutes, or yeah, I'll say 2 or 3 minutes. If you gotta use the bathroom, go use the bathroom, get something to drink. That's fine. And then we'll come back and we'll talk about fibs, and then we'll talk about futures, and then we'll probably cut it at that. And then I'll kind of tell you guys about the probability levels that I put out. I won't go into how I necessarily get them, but I'll go into how to like kind of play them. If that makes sense. So we'll come back at like 146, 147. But if you have any questions, just put your questions in the chat, the preview chat, and I'll answer when I come back. Yep, all the opens will be discussed. All right, okay, we're gonna kind of go through field fast. I ain't gonna say fast, but we'll go through it with some speed. So everybody back. But just so FYI, I use a different fib set when I'm doing uh when I'm just fibbing just in normal. All right, everybody here, right? Okay, so fib 101, right? Uptrend. When you're fibbing from the bottom, swing high, swing low to a swing high. If you want us to continue to go up, what you're looking for is for us to basically retrace in this area, zero point 0.5 to 0.236. What that typically means is that momentum is strong and we're going to continue up, not necessarily just to continue up, but we're going to at least take out the previous, the hot that swing high. It doesn't always happen, but it's like it's and nothing is 100%. Let me just say that. But it's a pretty good chance because momentum, what they wanted to do is just put it enough into discount, right? For us to continue up. So what is discount, right? Discount is all right. Discount is basically anytime you pay less than 50% of the price. So if the price here is equal to zero and the price here is $1, I want to pay less than 50% because if I pay less than 50%, if I lose all of it, I'm only losing that difference. If I lose all of $1, I'm losing all my investment. So I'm losing. So if I have $1 and spend 50 cents, I'm only losing 50 cents of what I have. I spend the full dollar and I lose that. I'm losing a full dollar of everything I had. So think of it from that standpoint. Big money gets it down here. Retail, we be getting it up here. We be chasing FOMO, all the above. Not to say that you won't make as much money, right? But we're risk managers, right? We're here to keep our money, right? Because what happened is anybody who got it up here, right? What happened? They lost 50% of the value down there. So remember that, right? When we're fibbing and when you're looking to get into prices, you want to get in at discount. Now, I'm saying that with the idea that there are times when on a higher level, right, price may not go all the way to discount. Now, on a smaller time frame, it may have, right? So now if I fib from here, so this would be your swing, your October 22nd to your November 28th, or October 10th to November 28th, that's about what? 8 weeks, right? But in that meantime, right, in those days on a smaller time frame from a fractal standpoint, I'm pretty sure that we've retraced, right? So the thing about fibs is that you have to know what time frame you're fibbing on and understand that the higher time frame is always going to be your go-to. right? Especially if you're swing trading, even sometimes when you're day trading, right? So I'm looking at a week, right? So if we look from October, right? Boom, pushed up. Now we go to the next one, right? So say if we go here, we came to the 0.382 on this level from this move, but from here, right, we went to your 0.618, right? Now, you want to, when you're drawing your fibs, not to say that the 0.618 isn't a good fib to get off of. It is. It's a very good price, right? You have to be careful though when we drop down to these 0.786 and 0.886 levels on your lower time frames, because a lot of times when we drop into those levels, we're usually not going to always make it to your point, to the back to the high of that move or to your extension. And normally you'll see that in chop, right? In chop, we go from, well, it'll look like this. On an intraday standpoint, you'll do this: deep retracement, deep retracement, deep retracement, deep retracement. Now tell me, right? This looks like some type of pattern, right? It's basically building pressure to either go down or to go up. But what they're doing is they're faking people out. They're getting people who get in down here and they're whoop, fake out, whoop, fake out. But it's doing a deep retracement to do that, right? Now, on your higher time frames, I would say your best retracements, you can probably go even down to your 0.618, right? Your 786, your 886. If you catch it there, you don't have to target the top of that high. Target that 0.382 level, target that 0.236, and let your runners do the rest of the damage. So when I'm fibbing, I'm starting my fibs on a weekly time frame, and I'm seeing, okay, where's the next pullback? Where are we going next? So if I'm looking here, right, all right, we hit this 0.5 level, boom, we pushed up. So here we hit this 0.236 level. But if I look at it from a daily standpoint, right, and I look from here to here, we did a deeper retracement, right? But this wasn't as deep a retracement. So you have to kind of know when to take the deep retracement versus when to not take a deep retracement based off of where you put your fibs at. So same thing if you are drawing fibs if we're on in a downtrend, right? From swing high to swing low, boom, there you go. And so typically, and I don't think this is the right one. Here we go. All right. Typically, right, when we pass that the low in which we created the where it retraced back from, you can target, if you catch it here, you can target basically that low, or you can target that is that negative 0.236 level, and then you can let your runners do what they need to do. So here you had a few times to get in, right? 0.5, boom, and then you'll notice you'll get reactions here. Now you'll see, right? You're like, okay, why didn't we go further? That's because the bigger trend was going up. That makes sense to everyone. So if you're fibbing on a weekly time frame, I'll say that you hold your contracts for a couple months. To be honest with you, you can go 3 months out. Now you're swinging on a daily time frame, right? You want to go 2 weeks to maybe a month out, right? So if you, or I'll say even a week. A week is fine. A week to a month out, because here, boom, caught that 0.5 or caught that 0.382, got close to 0.85, 0.5. You got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, basically 14 days till we almost hit this 0.236 level. But you had about, you know, 10 days here and you had a move of almost 200 points, right? Pretty decent size move. And then here, right? Boom, at 0.5 level. As soon as it hit it, 20 days, 240 points. Could have sat this trade. Didn't really have a real drawdown. You might have had just loss in profit, but not necessarily drawdown uh from SPX, right? SPX didn't drop past 350, 386, 5862, but maybe an hour, right? And then it pushed up. You're never in danger, right? And if you see, right, this 0.5 level is holding up from this field. Right? So now let me draw from here to here, right? See how you have this overlapping field? Anytime you're drawing fibs that overlap, those are strong bases of support. Just FYI. Go to a different ticker. Look at Tesla, right? What do we hit? 0.618 or zero point 0.7, major reaction. So now what I would do is if I'm trading this and I caught it here, right? If I'm not sure about us going back down or going back up, right? I may just target this 0.236 level, right? Now, 0.36 from 375, 80 points, right? Or 75 points, 76 points. That's a pretty good move on Tesla. 2 3 week contract, right? Now, if you believe in the move down, right? You hit this point six, point what, 7 level, came down, boom, pushed back up, right? Now, what I would be looking for is, do we get some reaction, right? In this level, right? Or do we get some reaction in this level, right? Because if you notice, what do we have in this react? And what do we have here, right? Number one, we filled this gap. Right? Now you have another gap here within this field. Right? Actually, let me move this up. I'm sorry, wrong. There we go. So now I would be targeting this area if I believe that. Say if you're trying to get in, maybe you start if you believe we're going down, maybe you start a position here or you start a position up here. I would say start up here with Tesla being on a long-term move up. That's how I would play it. I wait until we get to this 0.786 level, then come back down. I think we even talked about this a while the last class because we said to get in when it came down here to fill these gaps, which it did, right? Now it's working its way back up. Let's see if us, closing below this means that we're going to start coming down, or if this was just a smaller time frame pullback, right? I say smaller time frame, I'm speaking about a day versus looking at it from like a week standpoint or a 2 week standpoint, right? Or even a month, right? In a month, we're back green, right? So look at your higher time frames to see what that month looks like. If that month is green and we're above of course, if it's green, we're above the open. But if we're above the open, we're above the previous month, close. That signifies bulls. That signifies bulls are pushing the price back up. And then once we get above the high of that candle, it's, you know, you don't want to chase that, but you can feel confident that, you know, the bulls are in there. So yeah, if you're in Tesla calls, look at the reaction at the 419 and the 430 area, and then look at the reaction. We pass by that. Look at the reaction at the next with the gap fill. Like I said, you can do this with anything, right? Any ticker, swing high, swing low, or swing low to swing high will be you fibbing retracements to go back up, right? So we hit this 0.5 level from here, or we can go even here, right? Hit that 0.5 level, it's shot up, right? That would be a better look on a weekly time frame. So when basically from November 25th, we hit 161 all the way to 52, and you got your reaction here. Boom. And yeah, people can say like earnings cool, dividends cool, but at the end of the day, the market is based off of numbers, right? And so fibs are numbers. There's a reason why a lot of times you'll see things hit golden pockets. You'll see things hit those fib levels and have a major reaction, right? You have your reversal candle here, right? Boom, push up. And when it pushed up without any authority, now if you even wanted to look at it from this standpoint, right? You missed this. What happens with big money and their friends? What do they like to do? Buying discount, right? What happens on this candle? We go all the way in discount, 0.618, push up. Make sense? So anytime y'all, if y'all need some help or you know anything drawing fibs, just let me know. You know, I'm more than happy to help y'all. Just you know, either put it in a message, put it in my chat, and you know my channel, and I'm here all day. You know, we're here to help y'all. So fibs is pretty much if I'll say this: while you're starting off drawing fibs, take trades and it retraces, take trades in its 0.5 to 0.618 level. You know, there's times when it doesn't give you that entry, be okay with missing it. That's what I say. Then when you get more experience using fibs, that 0.382 and that 0.236 are very powerful because that's basically saying they're not trying to let anybody in if they're going to continue up or continue down, if that's where they retrace to, and retrace only to it. So you'll see like right here, we pushed up pretty fast in 4 days, 5 days. 3 days, we based, didn't get lower than here, and they pushed up quick. But now from here to here, you don't get that same read. You know, we retrace a little bit. And so if you notice, we retrace. When we trace this deep, by the time we get up here, we lose steam, right? And as you notice, after that, we kind of just drift, right? Come back up, we drift, but we never really push back, right? But now if you look from here, this was maybe all part of the program. We just basically those deep retracements in between up and down, up and down. That's what we're doing, coiling, right? Building pressure. Pop up. Happens on the downside too. I don't know if I can find one here, but questions. I know I blew through that because I want to, want to make sure I don't want to keep y'all all day. This is one of the longer classes I've had. But all right, let's go to futures, right? I'm gonna go through my daily uh how I draw, how I do futures, right? So around 7 o'clock in the morning, it might be a little early than that. 7 o'clock in the morning, one of the things that I do is I will uh draw the high and low of the day, right? Figure that out. There we go. Quarters. Actually, no. Here we go. Boom. All right. Got my previous day high, got my 50%, and got my previous day low. Those are important to me. All right. Those are the first things that are important to me. Next, what I do, and this is a TNTW or WO. This is more so because you asked, and this is what I was gonna go over anyway. But now I start plotting my hourly opens, right? So I plot 7 of them. The 12 from midnight to 7 a.m. are the first ones I plot. Right? So 7 a.m., 1 a.m., 2, and then so I mark them. So, so midnight. Where are you at? Where you at? Where you at? All right, midnight. Now you're gonna see percentages next to these. Let me do this. There we go. All right. Now what day was this? This was Thursday. All right. So you're gonna see percentages next to these. How this works. Our market is a ranging market. It just happens to go up. And what I mean by that is this. This. We trend 20 to 30% of the days that the market is open. The rest we range. So you'll have this boom, 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 boom. Ranging day, even if we end up here, right? Trending days. Trending day is like this. You might have this, you might have that. It's a trending day, in which basically the hourly lows, whether up or down, weren't at risk of being hit. On range days, those hourly opens, we like to go back to those for some reason, but statistically we do. So statistically, midnight, we tag that from 8 to 11:15 on NQ 68% of the time. 1 o'clock to 1 a.m. between 8 and 11:15, almost 69% of the time. 7 a.m., 86% of the time. You see how these get higher as we get closer to 8 a.m.? One of the reasons why is because typically the 7 a.m. open is typically a lot closer to the 8 a.m. open than midnight. But still, at a 67 for 68% clip, we hit the midnight open between 8 a.m. and 11:15. And this is over like the last 1,000 sessions. So it's not even this data is a little bit more in depth than even the data with SPX. So all right. So going back to how I form out my day, right? So if you have questions, just let me know. Like I said, I'm moving it through this kind of fast, but I want you guys to kind of understand where I trade this. So all right, so then you have your midnight open, you got your 1 a.m., got your 2 a.m., and this is my typical workflow, y'all. So 2 a.m., you got your 3, and I'm marking the hourly opens. Remember, candle anatomy, your opens are going to be at the bottom if it's a green candle, at the top if it's a red candle. Right? So this is your 3, 3, 4. Uh, 6, 7. All right, cool. All right, let's get cooking. 7 a.m., 6 a.m., 5 a.m., 4 a.m. All right, we'll just do a replay, get this all out the way. So, all right. So I'm doing this at 7 o'clock in the morning, right? Now, mind you, right, where are we at from here to here, right? Boom. From this move here to here, we're in this little area already at 7 o'clock. Right? Now, I'm only looking to hit these hourly opens from 8 a.m. to 11:15, right? Because those are the percentages that say that we're going to do that, right? Now, and this is one of the trades that this is what I took Thursday, right? So now let's go down to a 50. We'll stay at 30 minutes. So from once the uh 8 o'clock candle opens, right? Now it's open. I have one target to the upside. All the rest of my targets are to the downside, right? So all of my hourly opens are to the downside for what I would call the midnight retracement or midnight reversion type of trade, right? Now, with that being said, this day was 1-2. We hadn't hit midnight 12:23, 12:26, 12:27, 12:30, right? So that's 4 times in a row we didn't hit it. And then we hit it on 12:31. Well, think about it from a percentage standpoint. If I missed it 4 times and I'm supposed to hit it 68% of the time, that means I'm probably going to go on a win streak of hitting midnight open. Right? That makes sense to everybody? Because I've already missed it 4 times in a row, even though I hit it the next day. If the out of the next 10 times, right, or the remaining of the 10 times, I should hit it a good bit out of those times. In conjunction with we're in this 0.786 to 0.886 level. If I then draw the fib here, knocking out all of these basically would take me just to the 0.382 level. Knocking out this one would just take me to the point right underneath the 0.5 level. And so it's like I can take that trade knowing that percentages going my way, how fibs work are going my way. I'm not saying full port, but it's a full port type of situation for somebody like me, if that makes sense. It's like all gas, no brakes. We're taking this and we're going to live with the results. I'll put my stop previous day, call it a day, and I may even get back in. And it's only because statistics are telling me we haven't hit some of these hourly opens in the last 3 or 4 days, right? And it's saying that we should hit them 6 out of 10, almost 7 out of 10 days, 7 out of 10 days per our statistics at the minimum. So you got a few things working for you, right? You got the fact that at from 7 a.m. to 8. Now, this is for futures, just FYI. From that 7 a.m. to that 7:30, that that wick here was big selling pressure, right? That wick, this wick here was, or no, we bounced out of the previous 30 minutes wick and we shot straight down. Right? Now, when we opened up, right, when we went past the 50% mark of this wick, that was letting me know that we're probably going to at least touch this. And then with all my hourly opens, it's it's food on the plate. I gotta go eat. Just FYI. So we'll just move it to a 15 minutes so you'll see, right? So 7:30, 7:45, this is the 8 a.m. candle. Once it opened, I got into this trade and I took shorts, right? And so now, right now, it pushed me back up and I was in drawdown like a couple contracts on NQ in my personal account, but I was okay because of the fact that I knew that there's a chance that we would go hit this, right? This 7 a.m. open. I don't know if we actually hit it or not. Did we hit it? No. We like almost ticked it, right? So if you go boom, next candle, big drop down, right? Now we've knocked down all these hourly opens and basically what? The first hour. Not to say that always happens, but this is a good kind of indication of what happens when when you're trading that, right? You'll get a move up, try to knock out one side, and then we'll push down. Remember, we hadn't hit midnight in 4 days. I'm holding this, right? Still hadn't hit it. Then you get, I think I got it. Oh no, yeah, here we go. So the push up was kind of in this little area here, and then we shot down, and now I'm targeting, right? Now I'm targeting this, right? The reason why I'm targeting this is because we never went back to mitigate it, right? We never went back to, there's a gap here, there's equal lows here, there's previous day low, there's, just all type of, you know, I don't want to call it liquidity, but it's all type of, there's long people who went long. And when people like to go short, we like to take out those longs. And when they close their position, that just further pushes price down. So then we got pushed back up. I think I had took some of my contracts off here, and I think I was maybe in one or so contract, but I was up. I was in the contracts up here, so I was never in risk of losing, money, right? So then it went back up. I think it stopped me out here, if I'm not mistaken. It stopped me out, and then I got back in. And when I got back in, I wrote it all the way down. I think we all wrote it back down on this one, and that's when you had that big move. So those are the midnight to 7 a.m. hourly opens. Then you have your 8 a.m. to 3 p.m. hourly opens. We hit those probably about the same clip. You got some that are high, some are low, right? So in this situation, right, a lot of times when we make our move at 9 or 10 o'clock, you'll notice, right? So let's mark out, you'll notice the 8 a.m. Here. Let me erase all this. Go on your charts. I want you to look at from 8 o'clock to 12, right? And I want you to see how many times after 9:30 we go and we knock out the 8 a.m. open, the 8:30 open, and the 9 a.m. open in this time frame. These are pretty high. Makes sense for the 9 a.m. We're pretty close to it, but even at 7:30, 76.5% of the time, that's still pretty high. Go back and look at it. Do some back testing. See how often we hit it, right? And you'll notice that's a strategy that you can trade, right? You can trade, once market opens, definitely you trade futures to target that 8 a.m., 8:30 a.m. open. Because a lot of times we go and we sweep it, and then we go in the direction that we're going to go in. Now, the next thing I want you to do is after we've made our move, so you notice I don't have the 9:30 and the 10 o'clock here, right? That's because they're very low statistically. Because typically that 9:30, that 9:08, that 9:30 candle to 10:30, right? That is a distribution hour. We typically, once we make our move, we typically don't go back and touch the other side of it. There are some days in which the probability is like average, and when I say average, we touch it at like a 30% opportunity time. And there's other days like Tuesdays and Fridays, we touch it at maybe like a 15 to 20% time when we touch both sides of that 9 a.m. to 10 a.m. candle. But if you look at 10:30 to so if you look at this time frame, right, this hourly open, and it doesn't remember these are statistics, right? But because we range, this is going to be higher than us trending because of the fact that a lot of times we go up and down. Market makers like to catch people on opposite sides of the spectrum, right? They like to catch shorts, they like to catch longs. How do we do that? We range, we fake people out, we make premiums go down. So now if we look from here, right, from 12 to 4, right, we'll mark at 11:30. You see how often we go from one side to the other? And if we put on the 30 minute, because that's a little easier to see, What does that look like? Some people will call that chopping, and it is. But if you know what you're doing and you're catching and you're trading it the right way, right? If I put this here and I attack this 11:30 open, I'm jumping in out of this wick, right? And I'm taking it that way. Let's go the opposite side, right? Now this one you probably would have stopped out depending on your account. But what did we do? We went and touched that alley open or that, that open, right? Same thing. Came back, touched that one, right? Same thing. What? Touched that one, right? And then we touched all these in between, right? 12:30, boom, each one. And you'll notice this. You just got to go back and you got to look. Now, don't get me wrong. You can be on the opposite side of this, right? There's a high percentage and a low percentage, and you just got to take the losses with the losses and mitigate your risk. But you'll notice at the end of the day, right? Unless we just trade at the end of the day, you'll notice we just level out and we build that end of day wick. There's only certain days, but this may be a day in which the 12:30 didn't get retraced, but we retraced this 11 o'clock, 11:30, 12 o'clock. We traced all those, came back and retraced some of these, right? So boom, here's another day, right? And so we may not retrace them all in the same day. Like this might be the one day where, and this was FOMC day, right? We didn't retrace anything. It's FOMC. That's going to be your other percentage days, right? Your lower percentage days. And you just have to live with that. But if you notice, boom, you just start to just mellow out. But you notice here, right? 9:30, 10 o'clock, what happens? We didn't retrace, right? Retrace these. 10 o'clock, didn't retrace, right? Now we came back and retraced at 10:30, but this one, we left that one alone. And so you'll notice on distribution days, when Tuesday, Wednesdays, and Thursdays, sometimes we're not going to retrace because that candle is your distribution candle, the 10 or the 10:30. So on those days, right, if you're a breakout trader, it may be good to trade those days. Like, let me see, I think I have like a don't fight the trend model that I have, right? So here's a don't fight the trend model that I have, right? So on these days, and this is just me sharing some extra stuff with y'all, but on these days, can y'all see my screen? Can y'all see the spreadsheet? All right. So on these days, right, Fridays at 9 a.m., right, at 9 a.m. to 10 a.m., we typically don't go back and touch the other side. We do it on like a 70, what is 18 minus. So 82% of the time, we don't touch that 9 a.m. That 9 a.m. bottom or top wick, depending on which direction. So I'll give you an example. Right. So Friday, all right. So Friday, here we go. Touch that bottom wick. Nope. All right. Thursday. Thursdays are the 10 o'clock. All right, Thursdays are 10 o'clock. Right. Those are your better days. 10 o'clock? Nope. Right. Wednesdays, 10 o'clock are going to be your better days. Right. Nope. Right. Let's go to a Tuesday. Uh, Tuesdays are 9 a.m. Right. Once we break over one side, right, and it has to break over one. Let me say that once we break the other, you got to break the side, right. But whatever side we break, we typically tend to trade. Not to say we won't come back into the range, right? But once we broke it, we continue up, right? Monday to Friday, here's another Friday, right? So and so like everybody has their different ways of trading. Like I said, I'm a statistical trader, so I back test and I make I look at okay how often certain things happen, right? because the market does the same thing. When you really realize the market does the same thing, you can start building your trading model, with that, right? So, for instance, like on a Friday, right? I know that typically on a Friday, if we go long on a Friday, I'm not expecting us to go more than I want to say like I want to say about 0.3% drawdown. Really 0.15 to point 0.3, but point 0.3 is like my stop out. But I'm expecting us to go, I think, close to point 0.5, right? Did we go 0.5? We went 0.4, I think. Yeah, 0.4. Right. So statistically, that works in my favor, right? So knowing how often things happen and when they happen is important when you're trading the market, definitely when you're in positions, right? So um, so when you're trading these hourly opens, you have to figure out what's your entry type of how do you enter trades, and how you enter trades is how you determine how you get into it, and you go and you uh get in positions to target that hourly open. Right? What I typically do is I use the wick, right? So if we have a red candle here, so say for instance at 2 o'clock, right? At 2 o'clock, between 2:30 and 4:15, there's a 71% chance that we're gonna hit this 2 o'clock open. Soon as it gets to about 1:59, or it's 2 o'clock, two no 2:28, 2:29, I'm marking this out, right? And then I'm drawing my little boxer above the wick, right? And then I'm taking longs to knock out this wick, right? Or knock out this open. Now, with that being said, I got this 2 o'clock open, and I also have this open up here, this 1 o'clock open that hadn't been hit yet. So once I get in here, right, that's a guaranteed 25 points. I trade minis, right? So that's 25 per mini. That's an easy, what, $500, right? Then boom, and I'm moving my stop up. Every so often I move my stop. I'm definitely trading the hourly opens in the afternoon, right? So now look, you're at 70 points, right? If you didn't move your stop, I don't know how this candle formed, but say if it came all the way down, you're still in, right? Maybe you reload, right? Then you look up, now you're at 100 points per contract. It's $111. That's 2,200 per contract on a mini. Boom. Even if you take a micro, $220 in all of maybe what, an hour from 2:30 to 3:30, right? How many people make $220 in an hour? Think about it from that standpoint, right? And you have more than one micro, just add it up, right? So that's kind of how I play it. Now, the issue that you can run into, just FYI, is if you have hourly opens on both sides, right? So you say if you have an hourly open up here, you got an hourly open down here, which one do you take? Well, you have to kind of know the momentum of the market, or you allow one to be taken out first, and then you go attack the other side if it creates an entry for you to go take the other side. Does that make sense to everybody? So how, like I said, like going back, how I look at these hourly opens, I'm looking to target them, right, in these time frames, because percentage says we're going to hit them within this time frame. Now, with that being said, you have to use whatever your entry model is to get into a position. I don't necessarily, besides the one like for the afternoon, and I have one, the same kind of thing. You use the footprint to get in, but there's no ICT, there's no, you know, um, changes. There's changes, recs, and market structure. I don't really use that necessarily when I'm targeting these opens, like not necessarily, right? But I may use fibs, right? So if we look here, Where does this hourly open put you at? Right, dab smack in 7.8686, right? And I told you when we're ranging, we're more likely to do deeper retracement. So if I know that, okay, there's a 70% some chance that we're going to go up here, I'm definitely targeting this point 0.5. Once we knock out whoever shorted this, all we have is this left, right? My fib says take it on up, right? So if anything, I'm using fibs and and the hourly opens together with the combination of statistics to tell me to take the trade and to stay in the trade. Hmm. It was a pretty long class, y'all. All right. Any questions? Any questions? All right. So the last thing that I'm gonna go over is when you see let me see. All right. Okay. So when you see this, right? This is basically so let's look at the chart first, right? From and we'll put it here. I wish I could do it a different way, but all right. I want you guys to do this. Just this is some homework. Look at from 8 a.m. or no 6 p.m. to 8 a.m. Right? How many times we do this? We knock out all sides. Now we may not knock. There's certain days we may not knock every side out, right? But for the most part, and here's kind of one, kind of, right? But for the most part, we typically knock out both sides of both candles at an 80 to 90% clip from 8 a.m. or 6 p.m. to 8 a.m. on NQ. So you'll see here, knocked out all these, came down, knocked them back out, right? Same thing, boom, knock these out, right? We do it on this side, yep, knock these out around 8 a.m. We didn't knock these, but we knocked out all these here, right? So probably about 90% of them or 85% of them. Here, boom, knocked out both sides, right? Right. That one we didn't. This one we did, right? Boom, 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 right? So when you see my screen and you see me put up, uh, I'll look for it. When you see me put up things like this here, that is where that's coming from. And you see the percentages are based off the past year. It's us whether or not we hit basically both sides of the candle, right? So for here, we didn't hit these. If we short on Monday, right? Maybe Monday or Tuesday, I'm looking for these to be hit at some point. Price does not like to leave levels unmitigated. Unmitigated or inefficient, basically, is the best way to say it. So we have these candles. A lot of times they like to see red candles go through them and then come back up if they want to go back up or come through them and then go back down. But you'll see even with this one, I don't know if Dog Mom is still on here, uh, but you'll look and you'll see that hey, I called in my chat, um, and I said, hey, look, there's some more levels to the upside from Thursday that we might go hit, right? And this is when we were down here. I said, but we also have down levels. We didn't want to push down here around 9:15 when we created this candle, this 9 a.m. candle, right? From was it here from 9 a.m. or whatever it was, 9 to 10, and we went above it. I knew we were going to go upside and leave these alone, right? Now, if we would have created to the downside, the 9 a.m. candle and broke through here, these would have been great targets to target, right? So, like on this day, it happened, right? We had all these that we didn't go, we had all these areas that we didn't mitigate yet. When the candle broke down and we created our basically our distribution candle, we distributed downwards. And so you'll see, boom, same thing, right? So what I want you guys to do, definitely if you're gonna like, definitely if you like you're gonna follow some of the stuff that I do, go back and look. Go back into your charts and look at how price how much price ranges in according to how much it trades. And then also when you're looking at price, right? Look at how often you leave this area here unmitigated, either Asia lows or Asia highs. Definitely if you trade futures. See how many times we go back and get it when we don't touch it during London. Now, it may not always happen, right? But, there's a good chance that we go get it within the next couple of days if we don't get it that day. So, like, we have some up here, right? We could either go get those or we can come get these. We're kind of in the middle. So, it's up to us to kind of use entry models, whatever your entry model is. If DMAs, ICT, certain whatever indicators that you use, to allow that to feed into trading towards the high probability statistical levels. That's the best way to say it, I believe. So with that, I'm gonna end today's class. We did 2 hours. Woo! I don't know how 33 be doing it, boy. That man's a monster. But no, if y'all have any questions, please DM me. Like I said, my trading is a lot different than everybody else's. It's more so statistical based. And so which is why I don't give out uh what I don't give out necessarily entries and exits, but I put the statistics there on levels. And I'm not going to put a statistic out there that's going to be definitely when it comes to levels, that's going to be lower than 70 or 80%. It's always going to be high. It's typically always going to be higher, 80 to 90%. Just because I want you guys to have the confidence to take it, but use your entry model to take it. Um, And so I'll continue to repeat this class next Thursday. This class will go over and we'll go over pretty much the same thing. Now I got a good blueprint of how to talk about everything with you guys. And then at some point, we're going to try to, get to teaching guys, definitely guys who trade futures, because it's easier to do with futures. I'm going to teach you guys how to create actual trading models. And what I mean by that is just to kind of give an idea, something like creating models in which you kind of know like where not to. Here's not a good one. Is that the one I use? So this is a don't fight the trend model. I've got um I got a 3 hour 3 p.m. open model that kind of gives you risk management, what days to trade it, stuff like that. Kind of get you guys to like build a trading system in case you can't trade every day. Like, you know what I mean? So the good thing about these hourly opens is that you don't have to sit here and trade all day. You can come in here and you can, you know what, this 12:30, it's a 75% chance. I'm gonna just trade this when I have the time to trade it. I'm gonna just trade this when I'm gonna just trade this because I have time to trade this, right? And if I trade it every day at 72.1%, right? Typically I'm gonna be in more profit than loss, right? So Any questions, please let me know. I'm here to help. I know it's a lot of information. Like I said, we're gonna do this class over and over. Now I'm back home from Puerto Rico, um, and probably won't take another trip until a couple more months. I definitely have the time to really dig in and get this class going. Consistent how it was consistent back when we first opened the room. I know 33 been doing a lot of. He been holding the EDU down, but that's kind of a big part of what I do for this group is just helping with EDU. And and allow everybody, allow other guys to help with some of the other, with the alerts and the day-to-day lives and stuff like that. So um everybody knows me from, you might know me from other discords. You guys know my DM stay, that I open my DM to you guys to contact me. Please use it. You know what I mean? Please, let me know if you don't want to say anything in here. That's fine. If you do message me questions, I may put the question into the group just so everybody who might have that question. But if you don't want me to do that, I won't. I won't do that. But I'll never put you as the person who asks me unless you feel comfortable and okay with that. But yeah, just go through my FIB's channel and look through the things. If you have any questions on it, let me know. I know some people use it, some people don't, which is fine. Everybody, there's no ego in this room and no ego amongst the admins. So whoever you latch on to and want to want to trade, want to tailor your trading style to, do that. But I would say stick to one, similar type of styles, right? And so if you like Wickoff, do Wickoff. Wickoff is amazing. I'm telling you, it's amazing. Statistical trading is amazing. You know what I mean? You just have to have it's a different standpoint as far as like risking the same money every single time so that the statistics weigh in your favor. Understanding how to build a model in which the the model creates a statistical edge for you. So that's what it's all. That's more so what it's all about. You know what I mean? And then able for you to kind of trade specific times, hit your numbers, and go on about your day. Right. So like I said, if you have any questions, just let me know. You know what I mean? And we'll be here. So yeah, I appreciate y'all for coming to class. I know it's pretty long, so appreciate y'all's time. Y'all have a good day. Got any questions, please again, let me know.